Hey everybody, welcome back to 5 Minute Financial Markets. A lot to get to today. We had the big CPI number. We have a lot of movement in the market, especially in the future Fed funds rate. Let's jump into it. So CPI came in today at 6.4%, a little bit above where expectations were, and that led to a lot of volatility in the market. Taking a look at the 1 minute intraday chart, we opened up here, gapped lower from yesterday's close, quickly filled that gap and then some, came up almost to 415 to the penny. I've talked in the past about these key $5 levels on the SPY. Sold off from 415 right back down to 410, another key $5 level. Bounced off of that, broke through 410, chopped around down here a little bit, and then retraced the rest of the day to finish essentially flat to where we closed yesterday. A lot of intraday volatility, a lot of chop, and what looks to me like a lot of large players distributing their holdings and a lot of retail traders buying them up. More on that later. So if we go back to the daily chart, we're sort of in these competing channels. We've got this upward trending parallel channel that we've been in for the last 2 months since mid-December. We broke out of that on February 2nd and have since been in this downward trending channel. If you've seen my last few videos, you know what my opinion has been on this. I think the market is very, very weak and is due for a crash. And that opinion hasn't changed. Taking a look at the smart money, dumb money indicator. If you haven't seen this before, I look at the SPY or the S&P, that's equities, that's the dumb money, compared to the bond market, the high yield bond market, which is the smart money. Over the last several days, the SPY has been flat to very slightly down, whereas the bond market has had a very sharp sell-off. As I've said before, when you see divergences between the bond market and the stock market, generally the bond market has it right. They have much smarter traders, much more informed traders. It's a much bigger market. They don't have anywhere near the number of retail traders that the stock market has, and typically retail traders are much less informed than the professionals. And speaking of the bond market, what we're looking at here is the September contract for the Fed funds futures. This is where the bond market is pricing in the Fed's interest rate in September, which is what the market currently considers to be the terminal rate or the highest interest rate that the Fed will hit before they start cutting. You see this big green candle today. This terminal rate went above 5.25% for the first time ever. This is really bad news if you're the kind of person who likes to see the stock market go up. Stock valuations are heavily dependent on what interest rates are. The higher interest rates go, the more valuations get compressed, especially for tech stocks and stocks whose earnings are very far into the future. Those future cash flows get discounted by the interest rate to arrive at a present value. So the higher the interest rate, the more those cash flows get discounted and the smaller current day valuation you have. So let's take a closer look at what's going on with these Fed funds futures rates. So currently the market sees the Fed interest rate peaking at 525 to 550 basis points, or 5.25 to 5.5%. Just a couple of days ago, this peak was at 5 to 5.25%. And just a week or two ago, this rate was peaking at 475 to 500. So we've had a full 50 basis point move in the Fed funds terminal rate just in the last couple weeks. Taking an even closer look at this, and there's a lot of lines on this chart, there's a lot going on, but pay attention to the numbers in the top left corner. That's what we focus on. So back on Wednesday, February 1st, the market had priced in a 32% chance that the terminal rate for September was going to be somewhere between 450 and 475 basis points, or 4.5 to 4.75%. There was a 39% chance that it would be 475 to 500. So in other words, the most likely scenario that the market had priced in as of about 2 weeks ago was a terminal interest rate between 4.5 and 5%. Now we look at where those numbers are as of yesterday. You see that that's shifted all the way up to a 40% chance of terminal rate being at 500 to 5.25 basis points, to a 38% chance of 525 to 550. So in other words, the most likely terminal rate, the most likely outcome when the Fed is done hiking rates has moved from somewhere between 4.5% to 5% all the way up to 5 to 5.5%. So a full 0.5% move in the expected target rate. So what does that mean for the market? Well, let's look at the last time something like this happened. It wasn't that far back. It was June of last year. So Wednesday, June 8th of last year, looking forward to the February rate hike of this year, what the market at the time expected to be the terminal rate. You see the market priced in somewhere between 300 and 350 basis points as the terminal rate. Boy, how wrong were they? But that was the market expectation on Wednesday, June 8th. Then we got a really bad CPI number on Friday the 10th, and look at what happened. Just about a week and a half later, the expectation for that terminal rate jumped up to somewhere between 350 and 400 basis points, or 3.5 to 4%. So that same 0.5% move that we're seeing today. So what happened in the market back in June when this happened? Well, it wasn't good. Here's Wednesday, June 8th. We had a big sell-off, big gap lower, and a bigger sell-off. Bigger gap lower and a bigger sell-off, and then a few days later we bottomed out. All told, it was a nearly 12% sell-off in 7 trading days. Now let's look at what's happening here. That same 50 basis point move in the terminal rate between Wednesday, February 1st and today, and just a 0.5% sell-off in the market. So what's the difference between last June and today? Retail traders piling back into the market. As I mentioned before, retail traders, with the exception of the people who follow this channel, are generally much less informed and what they call dumb money. They are piling back in record numbers, and regardless of what the future Fed funds rate says, regardless of what the bond market says, they are buying up meme stocks, they're buying up Tesla, they're buying up Apple, they're buying up whatever they can get their hands on, and pumping up this market artificially. There's no way of knowing how much longer this can last, but it cannot last forever. A reckoning is coming, and it's coming soon. Stay safe out there, and we'll see you next time.